How much money do you actually need to start investing in the UK? It's a question I hear all the time, and it's one that stops many people dead in their tracks before they even begin. There's a persistent nagging idea that investing is a closed-off club, a game played only by those with thousands or even tens of thousands of pounds just sitting around. Many people picture slick city traders or imagine needing a hefty inheritance to even get a foot in the door. This belief keeps perfectly sensible people saving into accounts where their money is often losing value in real terms, thanks to inflation. This idea that you need a fortune to start is frankly one of the biggest myths in personal finance today. It's an outdated concept from a time when buying shares involved expensive brokers, hefty fees, and a level of complexity that deliberately excluded the average person. The financial world has undergone a revolution in the last decade. Technology, in the form of smartphone apps and online platforms, has smashed down those old barriers. Let's talk numbers. Many modern investment platforms in the UK will let you open an account and make your first investment with as little as £25, and some even allow you to start with just £1. Think about that for a moment. It's the cost of a takeaway meal for 2 or a few coffees from a high street chain. By making a small, manageable change to your weekly spending, you can become an investor. The goal here isn't to get rich overnight with that first £25. The real value of starting small is far more profound. It is about education, habit formation, and building your comfort level with the natural ups and downs of the market. When you start with a small amount, the pressure is off. One of the most significant innovations that allows people to start small is something called fractional investing. It sounds a bit technical, but the concept is incredibly simple and powerful. In the past, if you wanted to own a piece of a company, you had to buy at least one full share. This created a problem. Many of the world's biggest and most successful companies have very high share prices. For a beginner investor, that's an impossibly high barrier. You'd have to save for months just to buy one share in one company. Fractional investing completely solves this problem. As the name suggests, it allows you to buy a fraction or a small piece of a single expensive share. Instead of needing, say, £1,500 to buy one whole share of a company, you can use your £25 to buy a small slice of it. You would own 1/60th of that share, but you are still a part owner of that business. There's a common misconception that the most important factor in investment success is the size of your initial lump sum. People often think if only I had £10,000 to start with, I'd be set. While a large starting amount is certainly helpful, it is far from the most critical element for long-term success. The real superpower in investing is consistency. The simple, unglamorous habit of investing a smaller amount of money on a regular basis, month in and month out, will almost always beat trying to time the market with one big, perfectly placed investment. The steady tortoise really does beat the sporadic hare. This strategy is often called drip-feeding pound-cost averaging. When you invest a fixed amount of money regularly, for example £50 every month, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this smooths out your returns and reduces the risk of investing all your money at a market peak. Once you've embraced the idea of starting small and consistently, the next question is, what should you actually invest in? The sheer number of options can feel overwhelming, but the key for a beginner is to keep it simple. You do not need to plunge into the complex world of picking individual stocks, trading cryptocurrencies, or using elaborate strategies. The best starting point for the vast majority of new investors is a broad, low-cost fund. Think of a fund as a shopping basket that contains hundreds or even thousands of different investments. One of the simplest and most popular types of funds is an index tracker fund, like the FTSE 100 or the S&P 500. Because they are passively managed, their fees are typically much lower than those of actively managed funds. With a single global index tracker, you get instant diversification across countries and sectors, all in one transaction. Invest money you can lock away for at least 5 years, so it has time to recover from dips. Don't check your portfolio every day. Trust a simple long-term strategy. Start small with a broad fund, invest regularly, and let time and compounding do the heavy lifting for you.